Hi, my name is Hadley. I'm one of the moderators. Is there someone else as well, or
Yeah,
my solo?
Michael Carney here as well. So I'm with Upfront Ventures in LA.
Hi.
Yeah.
Nice to meet you.
Likewise.
Is it helpful to do like the 30 or 20-second intro? Co-founder of a seed fund here in New York in an SF called Eniac Ventures. We're on our fourth fund, $100 million. We lead seed rounds. Usually invest about half the round. Pretty much always lead. Usually focus on more technical businesses. Started with my three friends from undergrad, so we've known each other 25 years. All were entrepreneurs before this.
Great. And Upfront Ventures is a early stage VC firm, kind of core seed and Series A fund, $400 million fund. We also almost always lead, can write checks, call it $1 million to $12 million as a first check, and invest nationally. Although our whole team is based on the West Coast.
And throw the best conference that I go to.
Hopefully we get to throw it next year. We'll see.
Yeah. Glad you got it in before this.
We were we were last weekend of January. So I don't know if we didn't know, but we got it in and I don't think there was any casualties. So yeah.
Cool. Do folks want to fire out questions, or do you want us to ramble? What's most helpful? Maybe start if there are kind of specific questions.
I have a question.
Thank you.
My name is Amanda. I'll jump right in. I'm working on Hello Tempo, and we are a team of Stanford mechanical engineers building the future of women's health products, starting with the tampon, a leakage preventing tampon for active on-the-go women. Something that we have seen kind of shifting for us. We just closed a pre-seed round, thank goodness, just in time. But we were planning on raising a seed round fairly soon after and had a pretty aggressive milestone timeline to get to like a bigger commercial launch, do that seed round. Now we're kind of shifting, and the advice from our investors is have 12 to 18 months of runway, stretch it out as long as you can. We're lucky we can do that. But given the extension of that timeline, what kind of shift in milestones do you think that we're going to be looking at 12 to 18 months from now? Whereas maybe in like the world 3 months ago, it was like for a seed, do you have a great vision? Are you guys great founders? And have you shown product market fit? Are we looking for a little bit more maybe revenue, or are we looking for like solid metrics and indications of success quantitatively rather than just a great vision and execution?
How do you want to start?
Go ahead. I'll jump in after.
Yeah, I mean, I'll give you kind of the classic, hopefully helpful, but maybe unhelpful answer, which is it really depends on your industry. So I'll kind of try to speak to your kind of business, but I think it may not always be the same. So for a typical seed round, again, I think what you outlined is right, that you're betting largely on a team and on a kind of a macro thesis about a market opportunity, but you may not have quantitative data to show that this particular product or go-to-market is working kind of explicitly. I don't think that's necessarily going to change, but I think what, at least, in my own mind, and I'm starting to think about is having a higher bar for things like kind of capital efficiency. So I think to the extent you can demonstrate that not only do people want your product, but we have either a clever, creative, or unique way to get in front of them and get their kind of time and attention and money. Position hacks or kind of customer retention metrics that would lead an investor to believe that environment. And I talked about, but I think it's almost impossible today to know what the future will look like. But I would imagine most investors would be of the mindset that the future will look different than the past. Consumer behavior will look different. B2B buying behavior will look different. again, we don't know what that's going to mean. And hopefully we'll all have a better sense of that in, 3 to 6 months. And so maybe at the time period you're actually starting to have these conversations, there'll be a better kind of understanding of what the future might look like, but it's going to look different. And so one of the things, we're thinking about talking about is just how capital efficient can businesses be, and rather than making bets on, we're going to figure out the unit economics later. I think there's going to be a higher bar for businesses that fundamentally work. And so I think if you're going to, lean into particular metrics and things you could kind of de-risk or prove out at this stage, and that may or may not be possible depending on obviously your kind of product development cycle and where you're just going to be and go to market by the time you need to fundraise. But to the extent you can prove that the unit economics really work, and that if we had more resources, it could like pour gas on the fire, that we can grow efficiently. I think that's probably as or more important than the top line kind of scale of the business, would be where I'd start.
Yeah, I agree with all that. By the way, I'm also a mechanical engineer. Not many of us out there.
Chemical engineer.
Nice. The yeah, I probably bet on is that the kind of dynamics between investor and entrepreneur kind of will probably shift a little bit, in that there'll probably be we've been in really frothy times for the last few years at kind of all stages, including seed. And I expect we won't be in that position when you raise, or at least to the way it was, call it 3 months ago. So from kind of a valuation perspective and just the number of investors who are kind of leading seed rounds, I expect that will be slightly lower kind of on both of those. But it's really hard to tell the future kind of other than that in terms of dynamics. But I don't see like a real market shift. I don't think like the bar is going to move a lot in terms of what's expected. Folks are still going to see it as still a round where you're kind of buying the dream based on the team and the vision. I don't think it's going to get to a point where everyone's going to expect, what is now kind of Series A metrics. But, of course I could be wrong.
Could I chime in with a question? So out of curiosity, normally if you were before COVID, if you're funding a company and you expected them to have a certain amount of cash burn window, whatever it might be, 12 months, 18 months, 6 months, how are you now looking at companies to forward plan? Are you looking at them to maybe have 12 to 18 months, 24 months, like a longer window? I guess that's question one. And then linked to question one, because it's all about the projections, I guess, is when you guys see these projections off which you're underwriting some of your investment decisions potentially, how much do you typically undercut? Or yeah.
I'm happy to start. I think it's largely dependent on the industry and more importantly, or the business, but more importantly, the customer that the business is serving. And so again, if you're serving, let's say, the travel industry, I would imagine that your kind of forecast can be pretty bearish, at least for a period of time. If you're serving the healthcare sector, maybe it's more bullish. And so I would say it's really sanity checking how thoughtful and how serious the kind of entrepreneur and team have been about reflecting on what the world looks like. And so it's not gonna be the same in every case, but I think, as I'm having, new conversation with prospective investments, those are the kind of questions I'm asking is, in February or January, what did you think the world looked like? What were you projecting? What were your, sales cycle timelines and average deal sizes? And what were you projecting for churn? And what do you think looks different today? How have you adjusted those assumptions? And, there's no crystal ball. So I may have a different view on how aggressively you need to adjust those assumptions than you do. But really, again, part of the kind of evaluation process and getting to know you process with an entrepreneur is understanding how they think and how thoughtful they've been. And if they have a well-reasoned point of view and they can articulate why they believe, hopefully they know their customer and their industry better than I do. And if they can convince me that what they believe makes sense, that often is good enough. But it's really like, are you being thoughtful? Are you being Pollyannish? Are you, putting your head in the sand and believing that the world's going to look exactly the same in September as it did last September? If so, we're probably going to have a very different point of view on the world. And if you, again, are being thoughtful and pragmatic and you have, sound reasoning behind why you're making the assumptions you're making, then, hopefully, I can buy into that view. And then it's just a matter of, again, kind of conservatism versus risk tolerance. So like if you have 6 months of runway and you're making aggressive assumptions, that's different than maybe, and I'll speak to this more from the perspective of existing portfolio companies that we've been going through this process with. You can make aggressive assumptions as long as you have what data you're looking for and the timeline at which you're looking for it to reevaluate them. So you can make an assumption about the world's going to look like and kind of go forward with your business if you have enough runway to be wrong, and if you know what the data points and the levers are to adjust course, in real time. And so it's kind of a balance of those, risk tolerance and conservatism elements. But
yeah, I mean, for seed, our strategy is usually to keep burn quite low at the beginning after we do the round. Usually it's pre-product market fit, keep the team small, and then once we have those signs, start accelerating. So it actually will look like they have 24 months runway when we make the investment, but the reality is it will likely be brought in if we find product market fit along the way. So we're usually pretty conservative on that front, and that likely won't change. If anything, we'd be more conservative. In terms of kind of cutting your projections, I don't spend a lot of time kind of talk through it with the founder, just understand what their assumptions, how they're thinking about it. On the cost side, I do put a lot of kind of credence into that and want to get on the same page because that's something we really have control over. So want to make sure that we both agree on what we're going to spend, what the runway is and the burn to make that happen, and that we actually follow it.
Yeah. Maybe one thing to add is if you're a business, if you're in a position where you're really developing product and you're not kind of in market, you're not selling something, your timeline might not look that different. So if you were going to spend the next 12 months with your head down building code and you're going to come up kind of mid next year with a product, again, we don't know what the world's going to look like, but, I'd be willing to bet that as long as you're in, a sector that is not utterly decimated, that there'll be, commercial demand for most things in that time period. Now, again, that doesn't speak to fundraising or the ability to fund for the business. But if you're just building product, you might not do anything terribly different if you have a long enough time horizon. Most of our companies that are pulling back around things like sales and marketing and kind of go to market because there's just not customer demand in this moment, and we don't know how long that's going to change. So it somewhat depends on your business and your stage as well.
Yeah, it was interesting as of the 12, 14 companies that I either on the board of or run point for, the later ones were the ones that needed the most adjustments. So the ones that have raised Series C or B, especially, they have a lot of growth built into those, and those are the ones where unfortunately a lot of most of the layoffs we had to do or kind of the big adjustments. The really early ones, our most recent investment, to Michael's point, is a deep tech company that was going to be heads down and not going to have a product in market till the end of the year. So it's like, this really doesn't affect them. And luckily there's no kind of physical necessity kind of to be in the same place. So it really depends on kind of the details of your approach.
On that subject, internally, obviously most of our companies are laying out different strategies for different scenarios, depending on the recovery and social distancing, whatever that looks like. Is it worth being explicit with those different strategies and scenarios when you're fundraising and when you're meeting with potential investors and being honest with them, saying, I can't necessarily predict what 6 months will look like, but these are the 3 options that we have, depending on what the world is?
Yeah, I would say yes. I think one thing I see in repeat founders versus first-time founders is repeat founders are usually much more honest about what they don't know and kind of lay out their hypothesis and how they're going to test it, which is kind of what you're describing. And with the assumption repeat founders generally better. And what you described is kind of what we're having all our companies do is lay out different, especially 3 weeks ago when we knew less about what it's going to look like. Yeah. Not that we know, but we've got more information. So yeah, having certain scenarios and laying it out, I think, and being open with your thought process is definitely a good idea.
Okay.
Yeah, I would echo that. I think to what I said earlier, if you know kind of what decisions you might make in 45 days, kind of on an A, B, C basis, if you get certain set of signals and data, and you kind of have already pre-planned, that'll both make you more effective, but also if you're fundraising, will certainly make your investor more confident in kind of your process and your rigor. So I think that's good.
Okay.
Anyone else?
Don't make us call on you.
Hey, I'm Joe Benjamin, co-founder of Cheetah IQ. We're a B2B SaaS product. We launched January 27th. We built the product in January. We have revenue, things were going well. And then obviously Corona hit, sales cycles got longer, but business is still fine, like in a general sense. Should I spend any time trying to raise money given how early we are, or should I just completely put my focus into product and acquiring customers?
How long is your runway?
So personal runway, because we're bootstrapped, is at least 12 months. It could probably go to 2 years, but it's really just more of a, how is the business doing and what do we think like 6 to 10 months from now?
Were you going to raise now if it wasn't for COVID?
Well, we don't know. We think that it was probably something that we would explore to kind of get a feel of the market. But given that, things have changed and every customer counts even more now, like should 100% of my time be focused on customer acquisition instead of having like relationships built with VCs that may or may not go anywhere?
I think it's hard based on the information we have to answer that question. But I would say that I think we're getting to a point where most seed investors are starting to devote kind of closer to normal energy on new opportunities. And to the extent that you're not kind of especially hard hit with COVID and you have like a strong plan that takes it into account, like we talked about with, I think it was Daniel, then I think it could be a decent time to go out. But that said, if you are able to focus on the business and grow, this is more of like a personal finance question, then that could be the right route.
Yeah, I would say, it's not the worst time to be building relationships. I wouldn't ask anyone for an investment decision if you can avoid it in the next couple of weeks. Like if you could get on somebody's calendar for a week or two from now with the premise that, you're going to be raising in late summer. I think that's a reasonable timeline. And even if it's sooner than that, but again, if you're not desperate for cash and you can kind of give people the time to feel like they're getting to know you, because one thing that, we talked about this in my first panel, but one thing I've seen in our process is we're trying to spend, I would say, more time getting more touch points, more contact points, getting to know entrepreneurs because it's fully digital, because we can't sit down and break bread and kind of have a deep in-person kind of session and connection, opportunity. So if you can give people the kind of flexibility to get to know you over a period of time and it's not a rush process, that probably works to your advantage. And I do feel like, whether the news is good or bad, I think we're all going to feel somewhat more confident in 6 or 8 weeks about what the new normal looks like. And so that, again, works to your advantage. I don't think, I don't want to say, I'm probably neutral to bearish on the kind of long-term economy, but I don't think the VC sentiment is going to get worse in 6 weeks than it is now. I think it'll either crystallize where it is now or it'll get better. And so the kind of uncertainty doesn't work in anyone's favor. So if you can wait, until people feel like they have a handle on what the world looks like, that probably works to your advantage broadly. So if you can get in front of people and get to know them without any pressure to make a decision, that's fine. And if you can wait to force that decision, I think that probably works to your advantage.
Great. Thanks, guys.
I have a question around seasonality. That typical summer slump. Do you see that happening this year? On one hand, I'm thinking, well, the current situation will last a bit longer and we're just going to have to get really comfortable. On the other hand, I could imagine if travel restrictions ease up a bit, then it might even be worse than previous years where some investors are just dying to escape on some summer vacation. So do you think summer fundraisers are possible this year?
It also depends on the round you're raising. I think there's a big difference. In my experience, the summer slump's overrated for like seed rounds, but the later you go and the bigger partnerships you have, and also the more likely they are to their summer and Capri, then the bigger the concern is for slumps.
I'm thinking Series A.
Michael's probably in a better position. I can tell you. Go ahead. I'll chime in with what we've seen over the years.
Yeah, I would say by and large, I agree with that sentiment that the summer slump is kind of overrated in the sense that, we've always closed deals in the summer. I'm sure we will this summer as well. I would say most firms probably close some deals. If it's a slowdown, it's like 25%, it's not 100%. So the idea that like deals don't get done is not accurate. Again, maybe it's the bar is 25% higher. So the deals that are the most exciting and the most, high conviction get done no matter what, and they'll get done in days, not weeks. And the other ones will say, can we revisit this in 3 weeks? But I don't know what the world travel schedule is going to look like in July, so I don't want to forecast that. But I would say you should fundraise when your business necessitates it, and when the story you have is the most compelling, and don't worry about the travel schedule, especially at the earlier stage.
Actually, that's a good segue to another question I have.
Yep.
So if you have a lot of momentum right now, if the story is really great right now, we weren't thinking of raising Series A until later this year, but the pandemic has admittedly benefited us a lot. Is it foolish to go out now? Because I can see the obvious pros are, okay, everything looks good right now. The cons, I can imagine, are more skepticism around whether that bump is real or a factor of this climate. Yeah, I don't know.
Yeah, I think you're right to have the skepticism. I think, for me personally, especially with Series A, we would look for some kind of data that support that that's a durable change. And then there's even going to be instinct beyond that. Like what do we think the world looks like in 2021? But I think, we'd be more likely today probably to value a deal based on the trends kind of the few months before COVID than just this environment, I think. And I would reiterate what I said before. If you could start a process now, but not force a decision for 6, 8, 10 weeks, like that's probably a decent, putting aside the COVID bump, that's a decent process to run. If you, said, hey, we're going to fundraise and we want term sheets by like end of April, I think that's tough.
It also depends on kind of the dynamics that are driving that, to what extent there are things that most folks feel kind of could be longer lasting versus temporary. If they, I think a lot of folks kind of have different theses on things that they think, will stick to a certain degree. I think like remote work kind of is probably one of the more obvious ones. It's not going to be this extreme, but it's not going to go all the way back. So kind of where you fall on that spectrum would be a factor.
Maybe how about the flip side of that question? For example, if we had good traction before COVID in commercial real estate and retail, and then of course everything dries up, do you, just like you're somewhat skeptical of the bump and the durability of that bump, are you also kind of do you look backwards pre-COVID and use that and kind of smooth out the COVID interruption, or if that makes sense?
I would worry a lot of folks won't do that much. Like if you're in that situation, and you can make it past this, I really would try and do this. I just worry. The problem is a lot of VCs may not get into the weeds enough to like be able to get that. A lot of folks are kind of trying, they're looking at a lot of stuff very high level. It's very easy to kind of not get into the kind of bricks and mortar retail thing right now, so I would worry that that's just too nuanced of a sell for kind of the way that people process deals.
Yeah, I mean, I think that's fair, and I think to the extent you could have data of things getting back to normal, so like even if you're not at pre-COVID levels, but your kind of month over month trends are similar, if you could have 3 months in the back end of this that says, hey, we're back to our prior trajectory, that certainly would be to your advantage if your runway allows for it. I think assuming someone gets your business and gets excited about it and does get into the weeds, the question that they're going to be asking themselves is, was the drop off in COVID acute purely because people were unable to like meet face to face and do deals, or was it a change in kind of demand for the kind of core product and service? Like, is this a nice to have or a must have? And if this is a must have, but deals just didn't get done because it wasn't possible, but this continues to be a must have and the demand is as strong as it was ever going to be, and you're solving a real problem, then somebody who at least kind of gets your business and excited about the space will hopefully give you credit for that. You might not get the full credit. Like if you were at $1 million ARR and you dropped to $500,000 and you got back up to 700,000, you might not get the multiple or the valuation for $1 million ARR that you were at before, but they'll at least, hopefully believe that the business is still viable. If you can't sell the story about why demand dried up and the investor lands on the point of view that, hey, the world's changed and this was a non-essential kind of product or service, and I don't think demand's going to come back, you're going to have to kind of sell through that skepticism.
Yeah. Thank you.
Jen, Justin, either of you guys want to jump in?
I'm the student recorder for this panel,
Oh,
but
no pressure.
I'm really I'm really enjoying the discussion. Everything you guys are saying makes a ton of sense. So I'm just soaking it in. So no questions here.
Thank you for your service. Not sure. Do you guys know when this ends? Do we have 2 minutes left, or
I think it
5
was
after?
2:10, right?
Okay, so we have 7 minutes left.
Seven.
I have a question.
Daniel, go ahead.
Not really related to a problem, but I guess if we have nothing else to talk about, anything that you guys are seeing that's getting you really excited right now with what's happening in the world? Like, you guys probably have a much broader view of new ideas and changing ideas, and any categories in general that you're pumped about.
Yeah, it's something we're just starting to really kind of ramp up now because, as I kind of mentioned before, the first 3 weeks were kind of just heads down with triage, and then we got into PPP, and that was a whole ball of wax. So we're kind of starting to pop our heads up. There's the more obvious stuff that we're seeing, which I'm worried will just kind of get really crowded fast, like some esports, some telemedicine, distributed team kind of platforms, some e-commerce. I think the question is, are there kind of less obvious things or ways to address those in, like, for example, there's already been kind of a run on distributed team communication platforms, one of which we're investors in, but what are kind of more derivative businesses? So think about maybe the infrastructure that a company would need to kind of service a distributed team. What are some of the HR implications? So still kind of early in that thought, but I think that's where I would guess we're going to start spending more time.
Yeah, I think that's right. I don't have anything more specific than that. We are doing exactly what Eniac is doing, which is kind of really just debating, kind of everyone gets to throw an idea against the wall and people get to poke holes in it. And we kind of spend, the back half of our partner meetings last few weeks, at least starting to have those conversations, but I don't know that there's a kind of a clear winner or answer yet. And some of that, again, is going to depend on how long and how deep this kind of recession looks and what the world looks like on the back half of it. I think we're of the belief that there will be kind of sentiment change broadly amongst consumers and businesses in terms of just being more conservative and pragmatic for a period of time. And so we're certainly kind of asking ourselves, what are the, I think I used this reference for, but what are the kind of must-haves versus nice-to-haves in any category? But the kind of obvious categories seem like they'll, win. Certainly telemedicine, education, work from home, those are kind of obvious ones. And there are I guess the nuances within those categories are where we're trying to be thoughtful.
I think Michael makes a great point. We call it kind of the vitamin versus painkiller, which we've always kind of focused on. But in this environment, I think that becomes especially important to be a painkiller versus a vitamin, because it allows you to kind of cut through the noise, especially B2B, where you're really solving a problem.
Yep.
I have a tactical question that really has nothing to do with COVID, but
It's all good.
I redid our marketing site the other week in Webflow. And I first used Webflow back when it was in beta 7 years ago. I was like, this has a long way to go. But I thought, I'll give it another shot. Blown away. Such an amazing product. And I found it to be almost as easy as creating a really nice pitch deck in Keynote, which I'm very comfortable with. And I was talking to some other founder just the other day, and the idea came up with doing a pitch deck as a website, since Webflow makes it that easy, and you don't have to attach a PDF or use DocSend. I know, Michael, that Mark has railed against DocSend before. I've always shared PDFs with him. I'm wondering if you've seen that before, like a pitch deck as a website. How would you feel if you got something like that?
I've seen that once, where they had like a password protected website. I thought it was kind of interesting. I can't remember how I feel, to be honest, but it was well done.
Yeah, I've seen it more on the kind of resume portfolio side, obviously, than on the pitch deck side. I think it's interesting, creative, probably lends itself more to a business that is kind of brand design centric than deeply technical. Because I think in some ways it's like a Trojan horse for showing the investor your chops or your creativity. I think some of the same pushback against DocSend hold, which is like, how do I kind of download and archive this? How do I share it with my team? Is it, friction if I'm on the subway trying to download it, et cetera? But it removes at least the I'm being tracked piece of this, which again, I'm not super anti-DocSend. It's kind of part of the world we live in, so you deal with it. It's not my favorite thing, but it is what it is. I don't necessarily think it's a huge advantage in terms of the investor's going to say this is better than a deck. But if you think you can deliver a better product or better service, better story as a result, go for it. Who cares?
One kind of derivative of that I've seen that I thought was pretty interesting, actually one of the seed investments we made a couple months ago was the founder had his deck, which was kind of, the full normal thing, but it had kind of a publicly facing medium that kind of laid out a lot of the story. And that was kind of nice because it allowed you to have something that's public that you could share with, experts and other investors and stuff that kind of got most of the gist out there to get feedback. So I thought that was kind of a nice kind of, two options, one that's public, one that's not.
Yeah.
I like that. Thanks.
So I think it looks like we're going to get kicked out of here in 25 seconds or so. So maybe we'll wrap there.
Yeah. Thank you, guys.
Nice to chat with everyone. Good luck.
Yeah.
Thanks. Good luck the next couple months. Yeah.
Thank you.
Thanks.